Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is May 28, 2026. We're Elena and Marcus.
Right, and we have four critical themes from today's data deck that demand your attention right up front.
First is the geopolitical de-escalation framework.
Yeah, a tentative U.S.-Iran ceasefire extension is driving a massive cross-asset reversal across the board today.
Though it remains crucially unsigned by the president.
Correct. Second is the macro squeeze. We're going to examine how a softer core PCE print combined with falling oil prices pushed Treasury yields significantly lower.
And equity indices to fresh records.
Exactly. Third is the AI and short covering equity squeeze. We are tracking a major mechanical reversal in unloved software names.
Alongside some blowout AI infrastructure earnings from Dell.
Right. And fourth is the gold divergence. We will analyze why the precious metal is catching a sustained bid, even in an aggressively risk-on environment.
Moving to today's data, we really need to begin with the foundation of the current market architecture.
Right, the macro picture and global rates.
Because the sudden drop in geopolitical risk instantly repriced the bond market this morning.
It did. If you look at our daily desk data, the 10-year yield fell 3.1 basis points to 4.452%.
Yeah.
And the 2-year yield fell 1.6 basis points to 4.024%.
Which leaves the 10-year, 2-year curve sitting at 42.8 basis points.
A modest steepening.
Right. The geopolitical headline regarding a tentative 60-day ceasefire extension in the Middle East, that provided the initial catalyst.
Yeah, but the move was cemented by domestic economic data.
The April core personal consumption expenditures index.
Right, the Federal Reserve's preferred inflation gauge, it came in softer than expected.
It printed at positive 0.24% month over month.
Compared to the institutional consensus of 0.30%.
Let us apply the first principles rule here for a moment.
Sure.
Because for a non-professional investor reviewing their portfolio, the mechanics of how a drop in bond yields filters through to broader asset classes, it can sometimes seem opaque.
Yeah, I mean, it's not always intuitive.
So explain the exact mechanism linking a potential ceasefire and a softer inflation print to an immediate surge in technology stocks.
Well, it is driven by the inflation risk premium and its direct impact on the discount rate.
Okay.
When geopolitical tensions ease, the immediate market reaction is a drop in oil prices.
Because the threat to supply lines diminishes.
Correct. And lower oil prices naturally lower the expected path of future inflation.
Right.
When you combine that with the demonstrably soft core PCE print, bond investors demand less yield to hold long-term government debt.
Because the threat of inflation eroding their fixed returns has diminished.
Exactly.
Understood. And as those long bond yields fall, the discount rate used by institutional valuation models adjusts downward.
Correct. A lower discount rate increases the present value of future corporate earnings.
Right.
Technology and growth stocks, which are valued based on cash flows projected many years into the future, they become mathematically more attractive to institutional buyers when the risk-free rate declines.
We saw the appetite for that debt play out very clearly in today's 7-year Treasury auction.
Yeah, it was a very solid auction.
The bid-to-cover ratio was 2.52 times, signaling robust end-user demand.
But the critical metric in our proprietary updates was the dealer takedown.
Right.
It came in at a remarkably lean 10.42%.
Explain why that matters.
The dealer takedown is a vital indicator of market health. I mean, primary dealers on Wall Street serve as the shock absorbers of the financial system.
Yeah, they are obligated to purchase any debt that the open market does not absorb during an auction.
Right. So when the dealer takedown is that low, it confirms that foreign central banks and institutional asset managers aggressively stepped in to buy the debt at these new, lower yield levels.
The primary dealers barely had to intervene.
Correct. And we are seeing that appetite for yield bleed down the credit spectrum.
Right. Tightening spreads on BAA corporate paper.
And even CCC high-yield debt is catching a bid.
On that point, while the institutional market is absorbing lower yields, the consumer is not experiencing the same relief.
No, not at all.
The 30-year fixed mortgage rate hit 6.53% this week.
Which is a severe headwind for the housing market.
The cost of capital for a prospective homebuyer remains elevated, creating a real divergence between Wall Street's discount rate celebration and Main Street's borrowing reality.
Indeed. There's also significant institutional pushback against the pure optimism driving today's rally.
Right, from the Fed speakers.
Yeah, New York Fed President John Williams stated that policy is well-positioned, but St. Louis Fed President Alberto Musalem presented a starkly hawkish counter-narrative today.
He warned that if disinflation does not materialize over the next 1 to 2 quarters, a rate hike could actually be required.
Which runs entirely counter to the futures market pricing in rate cuts.
Yeah, Muslim attributed 75% of the recent rise in yields to a higher expected neutral rate.
And for context, the neutral rate is the theoretical interest rate that neither stimulates nor restricts economic growth.
Right, if the neutral rate has fundamentally shifted upward, the underlying cost of money must remain higher for longer, simply to keep inflation in check.
Moving to today's data on sector and equity flows, the macro tailwind from lower discount rates, combined with that geopolitical relief, ignited a highly specific rally in the equity space.
Yeah, the S&P 500 closed up 0.58% to a record 7,563.63.
Marking its sixth consecutive gain.
And the Nasdaq 100 outperformed, adding 0.84%.
But analyzing the underlying flows reveals this was not a traditional accumulation of shares based on fundamental conviction.
No, our prime brokerage desk notes that short exposure in U.S. products recently reached a 10-year high.
Right.
Today's price action was categorized as highly unwindy.
Yeah, this was a mechanical short covering rally.
Hedge funds had aggressively shorted specific sectors, anticipating economic deterioration.
But when the geopolitical news broke and yields dropped, those short positions incurred immediate losses.
Right, and to manage their risk and meet margin requirements, those funds were forced to buy back the stock they had shorted.
This forced buying accelerates the upward price momentum.
Creating a feedback loop known as a short squeeze.
Exactly. We tracked an index of expensive, unloved software names that jumped 8% today, purely on these forced unwinds.
The consumer discretionary sector was heavily targeted by these unwinds as well.
Yeah.
Institutional investors have been shorting consumer names under the thesis that persistent inflation was breaking the lower income consumer.
But in today's squeeze, Dollar Tree surged 17.9%.
And Best Buy jumped 15.8%.
Agilent also saw a massive reversal, jumping 16.87% following a Q2 earnings beat.
The most significant corporate mover, however, occurred after the closing bell.
Yeah, Dell Technologies.
They spiked between 22 and 30% in extended trading.
Following a blowout AI infrastructure print.
Looking at our latest run, they reported $43.84 billion in Q1 revenue.
But the standout metric was their AI server revenues.
Which surged 757% year over year.
Indeed. Dell is supplying the heavy-duty rack-scale infrastructure required to train and deploy large language models.
Right. The scale of these data center builds involves massive power management, cooling systems, and networking hardware.
By raising their full-year guidance by roughly $25 billion, Dell validated the ongoing AI capital expenditure supercycle.
It completely dispelled the dominant institutional fear that technology companies had entered some sort of digestion phase after last year's hardware purchases.
Correct. The print immediately dragged peers like Hewlett-Packard Enterprise and Supermicro Computer higher in sympathy.
On that point, we really must examine the internal breadth of this market.
Right, because if we look beyond the headline indices, the health of the rally is questionable.
Yeah, the S&P 500 equal weight index under the ticker RSP lagged the cap-weighted S&P 500 by 21 basis points today.
Furthermore, the Dow Jones Industrial Average barely moved, closing up just 0.05%.
Explain the divergence there.
It functions much like a basketball team, where two superstar players score 80% of the points, masking the poor performance of the rest of the roster.
Right.
The cap-weighted S&P 500 is heavily skewed by mega-cap technology and AI-adjacent names.
So when you assign an equal weight to all 500 companies, removing that disproportionate influence of the tech giants, the performance is significantly muted.
Correct. And the Dow Jones was heavily dragged down by the energy sector.
Moving to today's data on commodities and hard assets, that energy drag leads directly into the geopolitical headline of the day.
Right. The proposed 60-day ceasefire extension had an immediate impact on petroleum pricing.
Brent crude fell 1.76% to $93.31 per barrel.
And WTI crude dropped 0.83% to $88.65.
Yeah, traders were pricing in the probability of severe supply disruptions through critical transit routes like the Strait of Hormuz.
The moment the diplomatic framework was publicized, that specific risk premium was extracted from the market.
Meanwhile, natural gas decoupled from the broader energy complex.
It surged 8.79% to $3.303 per MMBtu. But this was driven by localized weather forecasts and separate supply dynamics rather than global geopolitical sentiment.
Correct. But the most critical divergence in today's data deck is the behavior of the precious metals market.
Yeah, this is key.
The US dollar softened, with the DXY closing below 99.
And oil sold off heavily on the assumption of peace.
Yet gold rose 0.84% to $4,492.50 an ounce.
And silver rose 1.56% to $75.92 an ounce.
If the broader market is pricing in geopolitical de-escalation, the bid in gold requires careful analysis. Why is it rallying?
Well, the gold market is pricing in the residual uncertainty that the equity market is completely ignoring.
The ceasefire memorandum of understanding remains unsigned by President Trump.
Correct. And Vice President Vance stated today that he is not yet ready to endorse the current framework.
Furthermore, Iran condemned U.S. strikes earlier this morning.
Right, alleging ceasefire violations before the ink is even on the paper.
So gold is functioning as a hedge against the binary risk of the diplomatic framework collapsing over the next 48 hours.
Indeed. It is also pricing in the structural reality of sticky inflation.
With the consumer price index running at 3.8% year over year.
Yeah, inflation remains significantly above the Federal Reserve's target.
Gold is a historic vehicle for preserving purchasing power in regimes characterized by both geopolitical fragility and persistent inflation.
Moving to today's data for our synthesis, we need to connect these distinct threads to define the current economic regime.
Right, and outline institutional portfolio positioning.
Equities are up, bond yields are down, oil is down, and the VIX dropped 3.38% to 15.74.
Closing below 16 for the first time since January.
This specific confluence of metrics is the textbook signature of a geopolitical risk premium unwind.
The broader market environment is aggressively pricing in a soft landing paired with immediate de-escalation.
The timing of the Axios report, which dropped at 10:25 a.m. Eastern, meant that Asian and European markets largely missed the rally.
Yeah, the FTSE 100 in the UK underperformed, closing down 0.75%.
Due to its heavy weighting in energy majors like BP and Shell, which tracked crude prices lower.
And looking at Asian markets, the Kospi and Taiwan were lower, with Taiwan actually down 1.40%.
Understood. But we anticipate a massive catch-up trade in the Asian session tomorrow.
The momentum from Dell's AI server revenue validation will drive heavy institutional flows into Asian server supply chain equities.
Specifically targeting manufacturers like Kioxia and Pegatron.
On that point, we must identify the asymmetric risk present in this current market regime.
Right.
The market is pricing in the reward of a finalized ceasefire, but none of the risk of its failure.
It is analogous to an insurance company writing policies for a hurricane that is currently sitting off the coast, assuming it will just turn out to sea.
They are collecting the premium, but the catastrophic risk remains entirely unhedged.
Which makes options-based tail protection remarkably inexpensive right now.
With the VIX at 15.74, implied volatility is historically cheap.
Yeah, institutional managers utilize this environment to structure asymmetric payout profiles.
For example, purchasing short-dated, out-of-the-money put options on the S&P 500.
Right.
Explain the mechanics of that specific options strategy for our listeners.
Sure. If the market continues to rally and the ceasefire is signed, those put options just expire worthless.
The portfolio manager simply loses the small premium paid.
Right, treating it as a standard cost of doing business.
However,
if the geopolitical framework collapses and the equity indices gap down 3 or 4% in a single session, the value of those put options expands exponentially.
providing immediate liquidity and offsetting the massive losses in the underlying equity portfolio.
Exactly. And the same logic applies to the commodity space. Portfolio managers are utilizing out-of-the-money call spreads on crude oil.
Correct. A call spread involves buying a call option at a certain strike price and selling another call option at a higher strike price to reduce the overall premium cost.
Right now, crude is priced for perfect diplomatic resolution.
If the deal breaks down and maritime transit is threatened, crude could violently re-rate back toward $100 a barrel.
So the call spread offers a capped but highly leveraged payout if oil spikes.
Serving as a cheap, targeted hedge against a binary geopolitical failure.
Understood. Let us review the core takeaways from today's data deck.
First, risk-on assets celebrated a tentative but crucially unsigned U.S.-Iran ceasefire extension.
Second, the AI capital expenditure supercycle was emphatically validated by Dell's massive revenue beat and forward guidance.
Third, bond markets found immediate relief in softer core PCE beta.
Though hawkish tail risks remain elevated if the disinflationary trend stalls over the next quarter.
Thank you for listening to Market Pulse by Orestes Capital, where Elena and Marcus will be back tomorrow with the latest market color.